So the data shows there are a lot of rental properties in New Zealand. I guess a trend started when government in 70s giving incentive to people to have rental properties, and this idea of owning rental property came through, that when people get to the retirement age, they do not simply need to rely on super, so they will have more than one income so that they can fund their lifestyle. So back then there were a lot of incentives were given to people so that they can write off all the losses from those rental properties. Can you believe it? Building depreciation was also permitted. So basically the policies, the tax policies were allowing people to put a lot of deductions into rental income so that they can fund their future portfolio. And people in 70s who were here, who bought a lot of properties, I personally know a lot of people, on an average, they had 2 to 3 properties. So by now they would have retired or about to retire, and they have a lot of income coming in. So that was the whole idea, that we created passion for property from then. Now, last 10-15 years, tax policies been very discouraging against rental assets, rental properties, but it's still a safe asset in terms of any financial assets, any shares, any crypto, any other things, because something you can touch and feel. Because this is overly used by a lot of people, so that's why whenever everyone go to the same place, there is going to be a lot of problems. So there have been a lot of problem over the year. So today I just want to show you next few minutes that what the current tax rules are and how you can navigate yourself to have a better rental properties, and what you need to know about New Zealand rental property tax. So if you're a first time investor, even a seasoned professional, you should watch this video. So why you need to know why this knowledge matters? This knowledge matters because you can avoid any unexpected tax bill or any problems. It ensures compliance with the IRD department. You can make informed investment decisions and reduce any future audit or penalty risk. What counts as rental income? Weekly or monthly rent that you receive, any Airbnb, short-term rental income, any border income. There are certain threshold for border income, insurance payout for lost rent, any bond amount that you have kept for damages. That all are rental income. What expenses can you claim? Of course, you know, rates, interest, da, 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 da. Yeah, all those stuff you can claim. Apart from that, legal fee for tenancy matters. Yes, you can claim that. Any bank and loan related fee, any valuation fee, any bank application fee, you can claim. And travel to inspect the property, of course, within limits. You can't say my property is in Auckland and I'm in Wellington, I travel 4 times a year. Again, you can, but there are a lot of gray areas here, so be careful around that. Now, expenses you cannot claim. Of course, you can't claim any private or personal expenses. That's general limitation applies. DA1. Any capital improvements? You can't do that. Initial repair. So when you bought a property and you do a lot of initial repair onto the property to make it available for rent, so be careful, because there have been a lot of court cases that those things have been denied. Seek professional advice before you put such a big claim there. Any mortgage principal payments, of course, you can't claim principal repayments. Interest deductibility from April 25, you don't need to worry about it. It's 100% deductible. Prior to that, it was partially restored to 80%. A new build, that dilemma, whether it's new build and stuff, that exemption has gone away. It may come back again, but right now it's not there. But it's always good to buy new build because you get maintenance free warranty for next 10-15 years. So there is always a good thing. And rules change frequently, so keep checking each year. One thing you may or may not know, yes, you can still claim depreciation on chattels. You can claim on carpets, appliances, heat pumps and things. You can have a list of your chattels and you can claim depreciation on that. This will reduce your taxable income. You cannot depreciate buildings. So that thing, of course, you might know by now, but 2011, that thing is gone. So it's gone for last 15 years. It's gone long ago. Bright line test, if you want to know, you can read this IRD interpretation statement, IR 1229. They have created a guide to explain what bright line tax is. Now, this period keeps changing, so it depends on the legislation of that time period. Family homes are generally exempt. Yes, they are exempt, but there are still some catch. I just did some work for a client. A lot of things I found there. Okay, so be careful around that too. Seek professional advice. Purpose, timing, and usage matter. Timing and usage and purpose, very important. Ring fences on rental losses. So rental losses are created into your rental portfolio. Those are ring fenced. Ring fenced, what it means, you can only use it for future rental income. This cannot be used against any losses. Those losses cannot be used against your employment income, business income, or any other. So only rental versus rental. Record keeping, you have to keep records for up to 7 years: invoices, receipts, loan documents, sale and purchase agreement, depreciation schedule. So these are all you may know or may not know, but if you're a new person, 7 years, that's the rule, that you got to keep your records for 7 years. Depreciation schedule means list of all the assets and their invoices related to those assets, such as your chattels, your curtains, your carpets, your blinds, these sort of stuff. You need to keep a record. And sell and purchase agreements. If you buy something, sell something, do not disregard it. Of course, it's available on your inbox, but save it somewhere so that it's readily available for your accountant, for the tax auditor, anyone like that. Common mistakes, very important. What we see and what a tax department see, problems there. Incorrect interest deductibility claims. Wasn't permitted, but has been put through. Private expenses put through, poor document management, chattel depreciation. Legally we can claim, but we are missing those. We only see land and building, no chattels. But if you have, then you can claim depreciation. And classifying improvements, very big topic. Improvements, what is capital improvements, what is repair? A lot of cases have been in the past on that. Don't caught up into a trap. So seek advice here. Look, if you like this video, I tried to share in a few minutes the whole rental portfolio and rental assets, expenses. If you like this video, please share with your friends and subscribe to our channel. Thank you.